It's even worse than I thought. You guys know that I've been harping on 2025 as a year that I feel substantial volatility may be coming for the market. Now, today I'm going to present more evidence where we can see clues as to why I feel that way and what we can do to protect our portfolio. Many years ago, Fed Chairman Alan Greenspan said that he felt the market was acting irrationally exuberant. This, by the way, was back in 1999, just 1 year before the market crash began in late 2000. We all know what happened. The tech bubble collapsed. The market fell about 50%. Well, how does one quantitatively find out if the market is in fact acting irrationally exuberant? I'll tell you how. We look at sentiment indicators. And sentiment indicators is a little bit of an area that I'm quite familiar with. After all, I wrote the book on it. I wrote this book, Smart Money, Dumb Money, about 3 or 4 years ago. I wrote it out of a passion for understanding crowd psychology and behavioral finance. This book is a very valuable tool for those of us who want to get a heads up on what might be coming for the market. And I think that anybody that's interested in investor psychology and following the crowd, but not following the crowd, should be interested in reading this book. Well, let's start off with learning about the investor sentiment cycle. And this is a chart that you're going to see in many different forms, on many different formats. It's kind of an age-old chart, but it really does help us understand the psychology of investors. So let's take a look. Well, when the market's going up, everybody is optimistic. We have investor enthusiasm, we have exhilaration as you're making lots of money. And generally speaking, the peak of a market is when investors feel euphoric. We've just made 25% on our market returns in 2024. Who's feeling crummy about that? I mean, we're all feeling pretty happy right now, aren't we? That's usually the feeling we have when markets are reaching a high. Now, what happens is, as the market starts to round over, we feel a little uneasy. And at first, we kind of deny the fact that the market's falling and it'll just recover. Don't worry, I'm going to buy and hold, I'm going to hang on, it'll come back. And by the way, markets always do come back, but do you want to see a 25 to 50% drawdown in your portfolio? Not that I'm making that prediction for 2025, but what I am saying is, historically, there have been many, many instances when we see 20 to 50% drawdowns on the market. So we want to be aware of the potential for this happening to the market. We don't want to live in denial. We want to do something about it. As the market progresses through a bearish period, we start to become pessimistic. And in fact, some people outside panic and capitulate. And that, funny enough, is the point of maximum opportunity. In fact, if we were to compare the point of maximum inopportunity, that's the stage of euphoria. Sir John Templeton once said, to buy when others are despondently selling and to sell when others are euphorically buying are the points of maximum opportunity. Well, at the bottom of a cycle, that's the time to buy, and the top of the investor behavioral cycle, that's the time to sell. And I think that we're kind of in this area right now, not so much in this area, and I would think that makes sense, again, after a 25% return or so on the S&P 500 over the past 12 months. We will eventually enter into another upswing on the market, but we need that healthy corrective phase. Whatever percentage the market draws down, we are overdue that phase, and it's going to be healthy for the market. So let's take a look at how sentiment indicators work. Start off with sentiment indicators measure optimism and pessimism. They quantitatively measure crowd behavior. And this is a key word for me because quantitatively measure is different than your opinion on how people feel about the market. You need hard data to tell you if the market is in fact irrationally exuberant, as Federal Chairman Greenspan once said. So we look at two groups, and we'll talk a little bit about that today. In fact, we're going to do a cage match. We're going to look at how smart money is behaving right now and dumb money. Well, how do we define smart money? Smart money is usually the kind of investor that we all wish we were. That's Warren Buffett. That's OMERS, Teachers Pension Plan, commercial hedgers, people that run the hedging programs for commodity firms like Barrick Gold. They will have to run a hedging program on the price of gold. These people in general are more informed than the rest of us. So we want to follow the smart money, and we want to do the opposite of, or fade, the dumb money. Who's the dumb money? Well, I have a little bit of a story for you. Dumb money is actually retail investors. That's Joe Average Investor. That's probably most of the people watching this video. But that's okay. You have to acknowledge the fact that we don't know as much as Warren Buffett and the commercial hedgers. There's nothing wrong with that. I do a program called BNN Market Call once a month. And many years ago, I was talking about this concept, this dumb money, smart money concept. And I said, well, dumb money's retail investors just like me and you. And I got hate mail the next day in my inbox saying, how dare you call ordinary investors dumb money? I'm not calling anybody dumb. What I am saying is we don't know as much as commercial hedgers, large hedge fund managers, and Warren Buffett. I'm sorry, we just don't. So we follow those guys and we do the opposite of our fellow retail investors, because retail investors are more subject to emotional investing, whereas institutions are more quantitative and data-driven than the average person. We want to follow the smart money and fade the dumb money. So finally, sentiment studies, when we look at these two groups, will give us a heads up as to coming market behavior. And I think you're going to see in the next few minutes that there's some clues as to what 2025 might be bringing us. Our first indicator is called the VIX. Now, the VIX is sometimes called the fear index. It's the volatility index, and it simply measures option premiums. How much option writers are asking in premiums for their puts and calls that they are creating and writing and putting on the market. Well, here's the thing, is that if option writers, who are actually part of the dumb money part of the equation, if they feel complacent, if they feel that the market's in a trend that's going to last forever, they will actually charge less premium on their options. When the VIX is too low, it indicates that options writers are complacent, and that's a sign of complacency. And history shows that when option writers are too complacent, the market invariably turns around and goes negative. Back in the late 90s, option writers were very complacent, as seen on this chart, and you can see the market ended up erupting into the crash that later became known as the tech bubble of 2000-2001. Well, let's take a look at other periods. Here we see a period of time in the late 2000s of complacency. Funny enough, 2007 was the peak of complacency for the VIX, and that was followed by the crash of 2008. Investors were too pessimistic. And we can look at the opposite side of this chart, by the way, and we can see that when the market did crash, premiums went through the roof. Now we moved into the too much pessimism side versus too much complacency side, but I'm here to talk about specifically too much complacency because, as you can see on the far right side of the chart, we've been in that low premium, too much complacency side of the equation. This usually sets us up for some negative market action. It doesn't tell us that it's going to happen next week or next month, but it's a setup and something we need to pay attention to. Our second dumb money indicator is the NAAIM index, N-A-A-I-M. And this is the National Association of Investment Managers. Now wait, are investment managers dumb money? Well, a lot of them are. So we use that as a quantitative way of finding out what the average investment advisor or investment manager is doing. Because quite frankly, investment managers, many of them, are crowd followers. Now I'm in that crowd, but I like to feel that value trend's a little different. I've been a contrarian investor, which is why I wrote the book on it. Anyways, let's take a look at how these folks, on the average, act during market peaks and market troughs. We'll take a quick look at the chart now, where you can see national exposure by investment managers was very high before the 2008 crash. What happened when the 2008 crash happened? Well, the investment advisor community was underexposed to equities. So they were buying high, selling low. More and more examples I can bring you through. I'll just bring you through a couple others. In 2018, do you guys remember the market correction, December of that year? Well, leading into that, investment advisors were very exposed, buying their clients or their portfolios equity just before the market corrected. And then when the market corrected, December of that year, they were out of the market. Isn't that fantastic? Buying high, selling low. Wait, that's not the way it's supposed to work. Well, here we go again. Leading into 2022 through 2021, the average investment manager was massively exposed to the market. And what happened? 2022. That's what happened. Look at this. 2022, when the market was at its low point, the average investment manager was out of the market, holding a lot of cash right at the bottom. They should have been in cash up here and buying here, but they did the opposite. So, final thing is to look at what's happening right now. The average investment manager was overexposed through 2024. And again, if this pattern repeats itself, things should take a turn for their market. Now let's take a look at some smart money indicators. And one of my favorites is the corporate insider buyer to seller ratio. Now you guys know that in every company, there are people called insiders. These are generally the upper management of every company, and they have shares in the company. They have to disclose if they are buying or selling their own company's stock. Now, one company's movement by a given insider does not spell disaster or opportunity for investors. Just because an insider is buying his or her own company's stock doesn't mean it's necessarily a buy, because they may have different reasons that they're buying, or they're vesting their portfolio, their options are coming due, something like that. This can happen. It doesn't actually indicate that it's a ripe time for you and I to be following them. Same with when they sell. Sometimes they're overexposed to their own stocks, so they start to sell out just to keep their portfolios in balance. But if we look at the entire S&P 500 companies, all 500 and some odd stocks that make up that index, and we net look at the number of buys by corporate insiders versus the sells, we get a large pattern, a crowd behavior pattern of what corporations are thinking about their own companies on average. And what we can see here on this chart, the corporate insider S&P 500 buy-sell ratio, is that when the ratio of buyers versus sellers reaches a high, that is, that there's much more buyers than sellers, you're usually near a market bottom. But when the ratio is reaching a point of net more sellers by insiders than buyers, you're usually near a top. It's quite accurate, as you can see here. Again, in 2021, you saw that insiders were net selling right near the top, but then, funny enough, at the end of 2022, right at the bottom of that particular market correction, they were buying. Well, what's happened recently? They're selling, net selling. Now, you can see on this chart that this can happen for a little while. It takes a little time for that top to be put in. The insiders don't necessarily time it with pinpoint accuracy, but as they see their own company stocks on the whole looking overvalued, they start to slowly pare out. And that is what has been happening during the latter part of 2024. This could carry on for a little while longer, but I can tell you that history shows us that when the insiders are beginning to net sell over a period of months, it tends to lead into a market correction. Why? Because these folks are the smart money and they know their companies more than you and I do. Final chart is a cage match between smart money and dumb money. Now, what Sentiment Trader has done to put this chart together is looked at every retail dumb money indicator that they follow and pitted it against every smart money indicator that they follow and come up with a net ratio of smart money versus dumb money confidence spread. And what you will find is that when the net ratio of smart money is more pessimistic than dumb money, then you have a low reading. And that tends to coincide with market tops. Now, if you've got a high reading, that means that the net ratio of smart money is buying the market compared to retail investors. And funny enough, that usually occurs near market bottoms. Why? Because smart money is picking money up at depressed prices because retail investors have been selling. Now, this is very often a leading indicator, and that's really what I want to talk about here. You can see that the net ratio of smart money versus dumb money was pretty pessimistic through much of early 24, and yet the market kept going up. Eventually, we saw this correction in May of 24, and smart money then bought everything they'd been selling in the first part of the year. So we are right now just coming off of a period where net smart money is less enthusiastic about the market than retail investors or dumb money. So we want to take this as a clue that the market is likely to correct a bit more, or perhaps a lot more, before the smart money starts stepping in. They're beginning to step in, but they're nowhere near the point like we've seen in past market bottoms where the maximum opportunity is here. In other words, smart money is telling us something. And that is that they're not convinced that now is the time to buy. And in fact, they're still pretty convinced that they want to raise cash. So what have we seen today? We've seen that investors who are classified as dumb money or ordinary retail investors, including investment managers, are overly exposed to the market, or at least have been. And this is usually a negative sign as a forward indicator. We've also seen that smart money is not yet dipping into the market with both feet. What we're seeing is that there's yet again more evidence for a 2025 that's going to have some volatility. I'll be coming back at you with more information and more videos on topics like this. Be sure to check out my blog at valuetrend.ca for in-depth charts and blogs.